Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals in our 25th year in business. It's midday Thursday, July 24th, and the title of today's audio blog is The Best Laid Plans, of course referring to the Steinbeck quote, "The best laid schemes of mice and men often go awry." And what better day to do it than during one of perhaps the cartel's most vicious attacks, most blatant attacks that I can remember, which is saying a lot. I mean, thank God for these audio blogs, as now that I have a 3-page daily writing limit, it is nearly impossible to inform you of the myriad horrifying global developments that threaten to destroy your financial net worth in the coming years. Heck, last week's audio blog was taped just before the MH17 airline disaster, which we wrote of extensively in articles titled Coincidence and Archduke Ferdinand Moment. Or for that matter, the worst Gaza Strip fighting since the 1967 war, the bankruptcy of Portugal's largest bank, Espírito Santo, the Fed accusing Germany's largest bank, Deutsche Bank, of having, quote, significant operational risk just 1 year after calling it, quote, horribly undercapitalized. How about the potential for Argentina to default on its bonds next week? The U.S. government on the verge of labeling MetLife, its largest insurer, a, quote, potential threat to the financial system. The SEC allowing money market funds to, quote, gate investors, that is, not allow them to redeem shares during times of crisis. Or Janet Yellen, with not a day of Wall Street experience to her credit, claiming U.S. stock and bond valuations are, quote, within historical norms, per the title of last Monday's article, as the S&P 500 officially becomes more overbought than the 2000 internet bubble peak, and Treasury yields plunged to nearly all-time lows despite surging debt, inflation, and geopolitical tension. Let alone QE, of course. Or how about this for irony? Today, the publication of Brazil's monthly unemployment report has been postponed due to a worker strike at the Ministry of Economic Statistics. These are but a small portion of the past week's headlines, which cumulatively work inexorably to thwart the power that be's best-laid deception plans. Never before has the global economy faced such dire, irreversible trends. And trust me, it's no coincidence that political strife, social unrest, and the threat of catastrophic war have become as ubiquitous as financial market intervention. And nowhere is such economic tragedy better characterized than the benchmark U.S. 10-year Treasury yield, of which more interest rates worldwide are based than any other. To wit, despite the relentless but rapidly fading tapering propaganda of the past year, within the broader 5-year recovery scheme, the 10-year yield has fallen to multi-year lows within a hair's breadth of the all-time low achieved just before taper talk commenced last spring. Globally, central bankers continue to harp on the need for indefinite, highly accommodative monetary policy, exemplified by the IMF's recommendation yesterday that the Fed maintain zero interest rates well past its current schedule of an initial mid-2015 rate hike. In doing so, the IMF cited the mythical deflation that is supposedly our greatest economic foe, despite the fact that definitionally, deflation is impossible in a fiat currency Ponzi scheme. Not to mention that even government-massaged CPI measures have been hitting multi-year highs, such as in the US and Japan, let alone real industries like the BLS's own foodstuffs index, which is up 19% this year alone, and US gasoline prices, which are just 12% from their all-time high in the early 2008, when the economy was doing much better, despite gasoline demand having fallen an incredible 75% from its 1998 peak, which was when the global economy peaked. Frankly, the only place where government-massaged inflation measures have not been rising at above trend rates is in Europe, where the ECB just instituted the suicidal policy of negative interest rates, with the promise of a $1 trillion QE program right behind it. Ironically, the European cost of living has never been higher, particularly when one focuses, as always, on the items we need to live on as opposed to luxuries we simply want. Back to the U.S. 10-year Treasury yield, we published 3.0%, enough said, in early January. Ironically, I thought it was one of the most important pieces I had written to date of the blatant Fed intervention, both overtly via QE and covertly via mystery Belgian buying and the like, to make sure the 10-year yield didn't rise above the key round number of 3.0%. Above that level, no doubt, fears of an out-of-control spiral of debt servicing costs would spread like wildfire, let alone the actual result of a collapsing global debt edifice. However, a strange thing happened when rates instead started plummeting in April, despite increased QE tapering and the promise of its outright end this fall. You see, tapering is nothing but a propaganda construct. As per what I just noted, QE is an ongoing, irreversible process, and in fact, in December I wrote an article called Proof of the Tapering Mirage, showing that the government prints far more than it says, and even leaves giant footprints showing it. Today, with 6 years of unfettered money printing, having created history's largest financial market bubble, the Fed feels comfortable in overtly speaking of an end to QE while continuing to utilize it ad hoc when circumstances call for it. In essence, it is not the economy the Fed cares about or has any control over, but instead the stock markets that give, quote, signals of how the economy is doing, false or otherwise. And don't forget who the Fed's owners are. Yes, the very same too big to fail banks that constitute the majority of financial market ownership, who, in large part, would be insolvent if FASB hadn't altered its rules in 2009 to enable them to account for the toxic mortgage-backed assets at whatever value they choose. Just look at last week's earnings from JP Morgan, Citibank, Bank of America. Again, the actual business is terrible, but the accounting changes they make, like loan loss reserves and proprietary trading on inside information with free Fed money, are what keeps them going. This dire financial condition is why ZIRP must be maintained ad infinitum, just as the ECB's LTRO lending program and the Bank of Japan's policy of essentially buying everything in sight, from Japanese government bonds to Nikkei stocks themselves. As I wrote in last month's Island of Lies, the only place on earth where positive economic data, which I put in quotes, has been reported in is the blatantly transparent U.S. labor market and hopelessly rigged, privately published, a la Robocop, diffusion indices that even MSM prostitute Bank of America yesterday said get way too much airtime and should be given little weight once hard data are released. As for the former, what more can we say about the BLS's phony NFP data, which not only is flat out falsified by phony birth-death jobs and seasonal adjustments that seem to only be positive, but even what they do report depicts the overwhelming amount of new jobs in either the part-time, temp, or minimum wage paying sectors, none of which pay enough to support a family, and none of which have a chance of ever paying the mythical benefits like health insurance that enabled the American dream to be possible. And oh yeah, the only category of job that has seen any growth since the 2008 crisis, and again, we're talking about part-time minimum wage jobs, is the 55-plus age group of senior citizens posting retirement due to a lack of savings, taking badly needed jobs from the dying 16 to 54 segment, which are moving back home with their parents due to a lack of savings and job prospects. Outside said island, which last week I wrote of as being increasingly isolated, the world of real data is decidedly collapsing, not just in the US, but worldwide. To wit, the Baltic Dry Index has fallen to nearly its all-time low, down 69% this year alone, and no, that's not a typo, after its worst July performance since 1986. Last week, for example, hopes that the so-called US housing recovery, which has been responsible for nearly half of recent GDP growth, that is when GDP was actually growing, were shattered by an unexpected 11% plunge in June housing starts. Said recovery was a sham from the first, based solely on cash-only transactions for $1+ million homes utilizing the Fed-printed money handed to the 1%. But let's not quibble about such facts, such as mortgage purchase applications falling to 20-year lows. And now, this morning's coup de grace, likely putting the final nail in the coffin of the housing recovery that never was. To wit, just hours after the newly public Market Information Service announced ever so slightly better than expected Chinese and European diffusion indices. In the latter case, coincident with Japanese exports plummeting to their lowest level since Abenomics began, U.S. new home sales were reported to have fallen, drumroll please, by an astounding 20% in June versus an expected modest 5% decline. In fact, Market simultaneously announced a weaker than expected U.S. manufacturing PMI index, including the lowest employing reading in nearly a year. However, the fix was in before we even went to sleep last night. Following the 3.0% Enough Said article noted above, I published another titled 2.6% Enough Said in May. Basically, I realized that just as 3% was being defended to the death on the upside, so was 2.6% on the downside. In other words, the Fed was just as fearful, if not more so, of rates plunging despite the so-called recovery and inflation they falsely purported, let alone the tapering they were supposedly doing. And thus they were willing to do anything to prevent the 2.6% rate that has represented its post-taper talk floor from being breached, in what we have called, in another article, the most damning proof yet of QE failure. Yesterday alone, the 10-year rate fell as low as 2.45%, until, for the fifth straight day, a late-day Hail Mary yield rally pushed it back up to 2.47%. Yes, the powers that be have become so desperate they have actually added 10-year Treasury yields to their checklist, along with the Dow Jones propaganda average of financial markets, which must be goosed higher every day in the final hour. Anyhow, anyone watching the PM markets closely knows the cartel takes precious metals, paper ones of course, down every single night. Not 90% like the 2:15 a.m., not 90% like the Sunday night sentiment attacks. Every single night, the second the ultra thinly traded Globex paper platform opens at 6 p.m. Eastern Standard Time. Last night, they followed up this usual activity with a violent paper raid at their typical 8 p.m. Eastern Standard Time key attack time, aiming to push gold below the key round number of $1,300 and ultimately get it below its 200-day moving average of $12.87 to quash budding sentiment. In the case of silver, it has clearly been capping at $21 an ounce for some time now, but getting it below its 200-day moving average of $20.35 was certainly their ultimate goal. This morning, gold approached $1,300 per ounce 3 separate times, including after the comically fraudulent weekly jobless claims number, again on that same island of lies, which plunged to nearly an all-time low despite government warnings of severe seasonal volatility. Not to mention the fact that weekly jobless claims have plunged synchronously with the labor participation rate for years now. Anyhow, the gold's high, post-weekly claims was, I kid you not, 1299.9, which is when the cartel really went into action. Unquestionably, today's goal was not only to attack gold and silver's 200-day moving averages, but bully the 10-year yield back above 2.5%. 2.6% appears to be a pipe dream at this point, particularly with the FOMC meeting coming up next week. But at least the key round number of 2.5% would serve as a start, and thus the aforementioned slightly better than expected European and Chinese diffusion indices, and I do mean slightly, to levels not only barely indicating expansion, but internally inconsistent among countries and completely at odds with reams of recent real data stating otherwise. Let alone the plunging Chinese employment component, which, like recent U.S. PMIs, should be a dead giveaway that what Bank of America said about diffusion indices couldn't be more valid. And in the former case, this strong European PMI came one day after European consumer confidence plunged to multi-year lows, and 1 month after German business confidence literally fell off the map. And not to mention the fears of what's going to go on in the Ukraine with natural gas supply. However, at 9:40 a.m. Eastern Standard Time this morning, that is 70 minutes past the weekly jobless claims data and 5 minutes before the PMI manufacturing diffusion index and 10 minutes before the new home sales report, they were forced into action again. Gold was trading at $12.99 en route to a taboo key reversal to the upside. You know, the type of free market action not seen in PMs in years. World silver was down less than a dime at $20.85 an ounce. Meanwhile, the 10-year Treasury yield was stuck at exactly 2.5%, clearly on the verge of plunging anew. And thus, out of the blue, yet another mysterious waterfall decline, such as what we saw last Monday and Tuesday to the tune of $5 billion of COMEX paper futures, with gold plunging as low as 1287 within minutes, and I should say seconds, and silver to 2050. The 10-year yield was simultaneously bulled up, but after the worse than expected PMI manufacturing diffusion index 5 minutes later, featuring the lowest employment component in 9 months, and the horrifying 20% new home sales collapse 15 minutes later, the battle for 2.5% was on. And right now, as I write, it's 2.51%. Again, we cannot emphasize enough what is going on here. That is, as in Japan and Europe, where record low rates are prevalent despite exploding sovereign debts, money printing, and geopolitical tension, the entire world is betting on QE to infinity. This is a perfect example of how even heavily rigged markets eventually overcome the best laid plans, or should I say, manipulations. For some time, we have predicted U.S. rates would plunge toward a Japan-like zero until hyperinflation sets in, which frankly could be a lot sooner than anticipated. Conversely, holding precious metal prices below the cost of production for so long will yield the most hellacious price explosion, more so in real than nominal terms, in the history of financial markets, and with it, the commencement of the inevitable endgame of fiat currency collapse, just as occurred in the 599 previous instances. Only this time the entire world is involved, which is why the odds of such resolution involving historic levels of war, poverty, and draconian government rule have never been higher. In our view, the past 3 years' historic, world-destroying campaign of money printing, market manipulation, and propaganda have very little remaining shelf life. Perhaps Jim Sinclair and John Williams will be right in their expectation of said endgame commencing this fall, but if not, it shouldn't be much longer than that in our view. As I wrote in today's End of Mining article, PM supply is likely to plunge as rapidly as demand explodes, and for those failing to take heed of the myriad, terrifying, horrible headlines engulfing the planet, the total and utter financial collapse of your portfolio is a distinct possibility. For those that take the initiative to protect themselves with physical precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, you can contact me with any questions you might have at ahoffman@milesfranklin.com. Thank you.